Hi, I'm Darren Wisson, Managing Director of Investor Relations at Envido Energy Partners. Thank you for watching our short educational video series. In our last video, we talked about the key components of oil and gas investing and overviewed some key terminology. Today, we're going to talk about the tax mechanics associated with oil and gas investing. Of course, we have to start with some disclosures, and the key disclosure is that this is not a solicitation to buy a security. That can only be done through a confidential private placement memorandum. Let's jump right into it. There are two primary tax drivers associated with oil and gas. First is the upfront deduction, and the second is long-term tax advantage income. Let's talk about those upfront deductions. The first is what we call an intangible drilling cost, or an IDC. And IDCs are non-salvageable costs, such as labor, drilling fluids, site preparation. Effectively, it's anything that cannot be removed from one site and taken to another one. All IDCs are 100% deductible in the year that they are incurred. Now, there is an option to amortize that deduction over 7 years, but most investors won't do that. And the IDC is the primary tool for offsetting ordinary income. Best way to think of it is, on average, IDCs will equal about 80% of an investor's capital contribution. That's why it's the primary driver. Now, as I said, the IDC is 100% deductible in the year that those costs are incurred. But IDCs do come with a 90-day safe harbor. In other words, if those costs happen within the first 90 days of the next calendar year, you're still eligible to earn the deduction in this calendar year. Now, there are some requirements, but most operators are going to know those and abide by those rules, so investors will achieve their IDC deduction in the current calendar year. The other key deduction is what's called tangible drilling cost, or TDCs. And TDCs are any costs that are salvageable, such as equipment or casing or wellheads. Essentially, any equipment that can be removed from one site and moved to another. Under the new Big Beautiful Act, TDCs became 100% eligible for depreciation in their year that they are incurred. Again, they can also be amortized over 7 years, but most investors won't do that. They can also be used to offset ordinary income. The key difference between an IDC and a TDC is that the deduction for a TDC does not come with a 90-day safe harbor. So let's talk a little bit what that looks like. Just imagine this as a hypothetical calendar from January to December. This is just a hypothetical scenario, but imagine that the fund that you're contemplating is closing in June, or a mid-year fund. That would give them enough time to spud the wells, which is another way of saying get the wells fully drilled. As an investor, you would be eligible for 100% of the IDC deduction and 100% of the TD section. So in this scenario, you would get a 95% deduction in the current calendar year that you made that investment. However, let's imagine a scenario in which the fund closed at year end, let's say December 31st. They would not have enough time to deploy the capital in that current calendar year, so all of it's going to fall into next calendar year. Because of that 90-day grace period, you would still be eligible for an 80% deduction because you would receive the IDC deduction in the current calendar year. But there is no safe harbor for the TDC, so you would earn that TDC deduction in the next calendar year. So the biggest difference about the total amount of your deduction is just when does the cost occur. But from the perspective of a fund, it's really, does the fund close early enough that they can deploy the capital? Easy way to understand this is just contrast the timing. And again, you can pick any amount you want. Now, this table, of course, assumes a 37% tax rate. Your actual tax savings will be different because you have a very unique situation. But in this situation, let's just look at the $100,000 deduction. For someone who invested at a year-end fund, they would be eligible for an 80% deduction in that current calendar year. That would be roughly a $31,000 and change tax savings based on a 37% tax rate, or a 31% ROI. However, if they invested mid-year, they would get a $95,000 deduction, give or take, which would equate to about a $37,000 tax savings, or a 37% ROI on the tax savings alone. The other half of the tax savings associated with oil and gas investing is the depletion deduction. And a depletion allows for an investor to recover the value of the natural resources they own as those resources are extracted and sold. There are two methods for determining your depletion deduction. There's the cost depletion, which is based on your actual quantities, and there is a depletion deduction, which is a simple 15% of gross income even after your basis has been recovered. Most of the offerings that you will contemplate will come with a percentage depletion because it's the easiest one to calculate. And you also continue to get deductions afterwards. The key is how to calculate what this means for you. Now, as I just said, a depletion deduction equals 15% of the gross income, but a fund will have associated with expenses and investors get the net income. The easiest way to understand this is assume that as an investor, you will get about 25% of your income will be tax-free. That is what the investors earn. There are many tax provisions associated with oil and gas investing. These are just a few of them, but these are the more important ones. The ones I'd like to highlight for you is IRC 469C3. This helps you understand the IDC losses are offset against active income. And of course, IRC 263C, which is the immediate deduction of the IDC. You can Google these and learn a little bit more about these associated tax provisions. When it comes to the upfront deduction, the key question you're going to ask yourself is, what do you offset it against? Are you going to offset it against ordinary income, such as W-2 or business income, or are you going to offset against passive income? Depending on which type of income you would like to offset, you will make a status selection when you make your investment. If you select to be a GP investor, then you will be eligible to offset your deduction against W-2, business income, any type of ordinary income. However, if you opt for the LP investor status, then you will only be able to offset against passive income. One of the questions we often get is, what is the AMT exposure to oil and gas investing? Key element is to understand is that IDCs are not automatically treated as a tax preference item for AMT purposes. You may be subject to AMT if you elect to amortize your IDCs over the 60 months. Of course, we would always encourage you to consult your tax professional for very specific tax advice. So here are the key takeaways. Investors can deduct approximately 95% of the capital invested. If you opt for a GP status, then you will be deducting against ordinary income. If you elect LP status, you will be deducting against passive income. The sum total of your deduction is based on the timing of the expenses, but from your perspective, it's the timing of when your fund closes. If the fund closes early enough in the year, then all of the expenses will be incurred in that calendar year and you'll get the full deduction. If the fund is closing at the end of the year, you will only be able to get the deductions that are eligible due to the safe harbor. And as you receive distributions from your fund, approximately 25% of that income will be tax-free through the depletion deduction. So that's it for this video. I encourage you to watch our next one. And of course, we're available anytime for a one-on-one fit assessment. Thank you so much for your time.